G'day, my name is Dean Crocker and I'll be taking you through the latest ER report completed on Total SE. On the 9th of February 2021, Total released their full year 20 results, in which they recorded a 32% decline in revenue to $120 billion, whilst the adjusted operating income fell 69% to $5.12 billion. This translated into a lower margin of 4.3%. Adjusted net income followed suit with a 66% decline to $4.1 billion, translating into adjusted diluted earnings per share of 143 US cents. Free cash flow from after organic investments declined 58% to $12.7 billion, whilst net debt increased by 19% to $37.1 billion. Total, however, did declare a strong dividend, increasing by 16% to 143 US cents per share. In terms of the segment results, all operations apart from corporate experienced significant pressure during the period, reporting lower operating income. On the date of release, the market treated the results released relatively negatively, closing 1.75% lower at 34.57 euros, relative to the Dow Jones, which only closed down 0.15% lower. However, since the start of 2021, Total has outperformed the Dow Jones by 4.2%, recording a total year-to-date return of 12.2%. On an EV/EBITDA basis, the group is trading at 3.2% premium to its 5-year average, but is trading at a 12.7% discount to its FactSet peers. The company was, however, severely impacted by COVID-19 and the oil crisis, which saw the dollar Brent price fall below $20 per barrel. This was further exacerbated by asset impairments totaling $10 billion. Despite all of this, the debt-adjusted cash flow did decline by 37%, which was a lower decline than the free cash flow, to $17.6 billion. Cash flow from operations fell 40% to $14.8 billion, while free cash flow fell 58% to $5.3 billion. In terms of net debt, it still increased by 19% relative to $37.1 billion, which relative to an 11% decline in the shareholders' equity translated into net debt to capital ratio increasing from 20.7% to 25.9%. Total has committed to transforming the business into a broad energy company with emphasis on renewable energy, and as such they have proposed to reduce its oil products contribution to sales from 55% to 30%. In terms of the assessment, Total was severely impacted during the period by COVID and the lower oil prices. This translated into significantly lower revenue, and that's effectively filtered down through the entire income statement, resulting in lower adjusted operating margins and lower earnings per share. This effectively resulted in a return on average capital employed reducing to 4% from 9.8%. Free cash flows remained relatively strong at $5.3 billion despite falling 58%, and Total also boasts an industry-leading production cost of $5.1 per BOE equivalent. Given that there's a significant increase in the oil price of late, this bodes well for Total going forward, and we should see a return to profitability and the margins that were at pre-COVID levels, so long as the dollar price of a barrel of oil remains relatively high. Total dividend of 2.64 remains very attractive, and Total has been able to continuously pay out excess cash flow to shareholders, even during this quite difficult period, shall we say, in which they continue to pay out a strong dividend to all shareholders. We, however, do feel that the company is undervalued and does potentially offer greater upside going forward, so long as you do see an increase in the oil prices. The transformation of the business to a more diversified, shall we say, energy provider with focus on renewable energy also offers greater benefit on the ESG side of components and valuation, and as such we conclude with an overweight exposure to Total. Should you wish to place a trade, please speak to the trading desk or your financial advisor. Just take note of the disclaimer. Enjoy your day. Thank you.